This GTV chart on the Bloomberg showing our viewers how the dollar is already fallen to a one-week low, back below its 50-day moving average. We had our Bloomberg analyst Cameron Kreis saying that at the current level of the twin deficits, he actually projects a dollar decline of 31% over the next 2 years. How much more weakness could we see?
Well, much of that is going to depend on what we see in the coming weeks and the election. When I look at the U.S. dollar, I combine that with a variety of other assets right now, and it says to me this market has prepared for a Biden win and a Democrat a Democrat sweep in its entirety. And as I'm looking forward to the next 2 to 3 weeks, whenever we get to the point where a market is, in my opinion, fully priced one outcome, I get a little bit nervous that you could have some volatility and some of those probabilities shift in the other way. So if in the coming weeks it might look like maybe those Trump odds start to change, that is going to have implications for that U.S. dollar. Just like almost every other trade out there, making big calls before the election is extraordinarily difficult. This can go in any way, and it will be a binary outcome for things like the U.S. dollar ahead.
Given, though, that we do have monetary policy that seems to keep rates lower for longer, or for what seems forever now, and other macroeconomic factors, we have seen this downtrend being a little bit more long-term issue. So how does this affect those companies, for example, that are more veered towards the domestic markets? We have seen this outperformance in the Russell 2000 as well.
So if we continue to see this weak U.S. dollar, I think it's just going to exacerbate this. I know we get tired of talking about it, but it's so important to internalize that K-shaped recovery, that difference between the manufacturing industrial complex that is not hit by social distancing, not as well hit by the consumer demand shock, and the rest of the economy. And that's going to continue to expand. And that also has implications for a lot of the inflation outlook. And combined with that weaker U.S. dollar, that is going to push import prices higher in the industrial complex. We're also going to end up with not just that K-shape when it comes to manufacturing and services, but price pressures in the industrial complex being much higher as well. So you're right to zero in. There's a very big divide happening in this economy, and big U.S. dollar moves are probably going to exacerbate it.
Frances, we are just getting the latest polling numbers when it comes to a Fox News poll suggesting that Biden has 49% against Trump's 44% when it comes to Wisconsin. Biden has 50% approval versus Trump at 45% in Pennsylvania, 52% for Biden, 40% for President Trump when it comes to Michigan as well. So we continue to see Biden potentially kind of getting his streak ahead when it comes to these key battleground stakes. President Trump is starting to really struggle there. Has markets kind of considered, I guess, what could be a worse case scenario where we get a Biden-Harris victory in the White House, but they don't manage to get control of the Senate? What does that mean for the prospects of policy making, in particular when it comes to these stimulus negotiations? Is that really a scenario of paralysis that markets aren't pricing in for at the moment?
I would agree. I do not think markets are priced in for that. Traditionally, markets like when you have a divided government because it means your sort of tail policy, your extreme policies don't get passed. But this is an economy that desperately needs a fiscal package. And if we do get some form of division that implies gridlock in Washington, not just a lower amount of fiscal, but a longer delay of fiscal, that is not going to be the same type of outcome that a market would like in this environment than it has historically. So this is exactly the question, right? It's not who's going to win the presidency, but what is the president-Senate combination? That two combination is what's going to be the big driver of how we think about not just the size of fiscal spending, but the type of fiscal spending. And increasingly, I urge everyone I talk to really pay attention to the type of fiscal. It's not just the headline number of that package. It's what's being contained within it. That's going to be the driver of growth. That's going to be the driver of inflation. And it may even be the driver of U.S. dollar strength or weakness ahead as well.
We had one analyst saying overnight watching the price action in the markets was like watching a cat chasing a laser pointer. If you're an Asian investor at the moment, obviously you're keeping an eye on volatility going into November 3rd. But should there be more focus on really the good news coming out of the recovery story, the first in, first out, the China recovery story in this part of the world?
In this next 2 weeks, I don't know any major portfolio manager that is trying to take on active risk or make big bets here. The goal is to focus on trends and ideas that will work regardless of who wins the election. And that manufacturing surge and Asia recovery first is one of those trends. Another one I would suggest is this massive repression being created by central banks in the fixed income market, and the fact that most of the inflation trade has to be expressed at the very long end of the curve. It's going to continue to push assets into under-owned asset classes, emerging market debt, infrastructure, things like REITs. These are the trends that we need to be watching in combination with the idea that whoever gets in, whatever combination, we are going to get a fiscal package. So large fiscal deficits, very low interest rates, Asia moving first. These are investable themes now that do not depend on the election outcome. Those will just be about, the size of that trade as opposed to whether or not it's a good idea.